First of two chapters of inventory. In this chapter, we're going to be getting into the different ways of valuing inventory, like LIFO, FIFO, average cost or weighted average. And we're going to get into some different methods of incorporating LIFO. In the next chapter, we get into inventory estimation, lower of cost or market, and all of that. So I'm going to begin this discussion sort of starting off slowly, just reminding you of some of the basics of inventory. And then from there, we'll get into some of the newer stuff. So just to get started, I just put up a balance sheet here. This is nothing to do with, in particular, any example we're going to be going through today, but I just kind of wanted to talk to you about where we're going from here. Because we just did a chapter on cash and receivables. We'd gone through the income statement, balance sheet, statement of cash flows in general, and all of that. So I just kind of wanted to show you sort of where we're going, right? So we're learning about each component of the balance sheet. So we just did cash and receivables, right? So whereas before we knew about, we know that cash is on the balance sheet, we know that accounts receivable is on the balance sheet. Hopefully now that as we go through this class, we're getting to know these items a little bit better. So for example, when you look at cash now, hopefully you're not just thinking it's just stuff in the bank. What maybe might you think when you're looking at cash? What would be in there? Stuff maybe that has a maturity date within 3 months, right? Where do you know you can get information about cash besides for on the balance sheet? There's someplace else in the financial statements that would give you information about cash. Cash flow is one of the places, right? And you know that the cash flow should equal this balance, right, in cash. And where else? Footnotes, that's exactly what I was looking for, right? This is going to give you information about cash, right? It's going to tell you what the rules are. Is it anything with a maturity date 3 months or less? What sort of things are they incorporating in there, right? You're not going to see things in cash that may be in a bank account, but maybe are restricted for different purposes, right? So now we know that there's more to cash than just cash, right? In accounts receivable, what are some things that we learned in the last chapter about accounts receivable? About determining what our accounts receivable balance is? Yes. There's the gross method versus the net method, which will impact, right, what our receivables, the way that our receivables are recorded, okay, between our receivables and our allowance account. What else? What else maybe did we learn about receivables? Maybe not just accounts receivable. What other types of receivables did we learn about? Notes receivable. And what are notes receivable usually? Right, and you'll generally see them in current versus non-current, right? But in notes receivable, you're talking about principal times rate times time, right? And so there might be interest that you accrue. So when you see interest receivable, you might assume this is related, to a note. Okay, but again, where could you get information about these things in more detail? In the footnotes, right? So when you're using your balance sheet and you're going down your balance sheet, hopefully as we go through these different chapters, you are getting to know these items a little bit better and what really these stand for, what types of items are behind there, where to get more information about them. Okay? So I just kind of wanted to start off just kind of talking about that. So here we're now going to enter this discussion of inventory, which is a big item that you will often see on the balance sheet of many different types of companies, and we're going to talk about those kinds of companies today. And then, eventually we'll get into property, plant, and equipment. We're going to get into all sorts of different things, but this is that's basically what we do in this class. We dig in a little deeper into these different items, okay, so we can understand better. Now we know how to make a balance sheet, but what are really the numbers about? What's behind them? And how do we use this information to compare across companies? So we're going to learn today about inventory. We're going to talk about all sorts of inventory methods. So after today's class, you should be able to look at inventory and know you can't just take inventory at face value. You need to understand the method that they use, okay, if you're going to be comparing companies and what the implications of those different methods are. Okay, so just a brief overview of where we're going. So anyway, so moving along. So starting with some basics here. So this should be a review for you of what you would have learned in your intro class. So we have all different kinds of companies, okay? We have some companies that sell services, So I made a little picture here. I have like, a nail salon because I like to get my nails done sometimes when I have time. Okay, they're performing a service for me. They're giving me a manicure, a pedicure. Okay, if some of you guys, or hopefully all of you guys now are going to be going into accounting and doing some kind of accounting work, auditing, taxes, you're performing a service, okay, for a fee. Then on the other side of that, we have some companies that sell merchandise. Okay, so these are two different types of companies. So some companies sell services, and these companies that sell services really are generating their revenue. They have service revenue, right? They have revenue from the services that they perform. So if you go and if someone does tax, if you go and do taxes for someone, the revenue you earn is for the service that you performed, right? And what do you think? Let me just before I go here, what do you think the primary expenses for a service company? Salaries, right? So we're dealing really with salaries here. On the other side, we have companies that sell products, or that sell products. These are merchandisers. They sell items, right? So what do you think a primary expense is for these types of companies? These inventory is a big, right, which becomes cost of goods sold, right? So, so to distinguish here, so when we talk about inventory, we are focusing on here, on these merchandisers. Okay, we're focusing on merchandising companies that have inventory. You wouldn't see inventory on the balance sheet of a service company. Okay? And then just, a little more information. Again, this is all review. Merchandisers, we have wholesalers that sell to other companies, which generally you're not going to, you might not know the names of a wholesaler because they don't generally sell to the public. And then we have these other kinds of companies that sell to the public. These are our retailers. Just some verbiage here. Okay, any questions so far? Just a bit of review. So again, as I said, service companies, really you're going to have service fees revenue, and the primary expense is employee wages. Merchandising companies have sales revenue. They have to maintain inventory. Okay? And that inventory may be inventory that they buy from a wholesaler, so something already made. So if you go to a shoe store and you buy shoes, if you go to like Aldo or I don't know, whatever you go to like Nordstrom or something, they sell shoes, they sell lots of different brands. Are they making those shoes? No, they're buying them already made. So their inventory is goods that they buy from a wholesaler. Alternatively, if you go to, I don't know, if you go to like Gothic Cabinet, you guys ever been to a Gothic Cabinet craft? No, it might make it like that's like probably one store and I'm the only one who knows about it. All right, well, so there's a place called Gothic Cabinet. They have them, they used to have them in the city, they have them, I don't know. So, you go there and you order furniture, they make furniture for you, like reasonably priced furniture. So they have like a nightstand and you say, well, I want this nightstand, I want it to be, can you give me one and paint it black or something? That's what, they make stuff sort of custom. Not custom necessarily, they have stuff in stock, but you can like custom paint it and it's all made there. They have inventory, but they manufacture their own inventory. So they, at any given time, so they're going to have inventory that may consist of finished goods. I have a slide on this later, but just to sort of get into the discussion, they may have finished goods. They may have raw materials, which they may have the wood that they buy to make the furniture, and they may have a nightstand that's partially made. Okay, when they have to do the reporting at the end of a period. So inventory can be finished, some kind of goods that you buy from a wholesaler, or it can be things that you manufacture on your own. Okay, so companies can manufacture their own inventory, or they can buy it already made. So if you're a manufacturer of inventory, in your inventory at any given time, you will have raw materials, work in process, and finished goods. And as I said, I do have a slide on this later, but I want to intuitively make sure this makes sense, right? So you can be either type of merchandiser, okay, and you can and all of those things are inventory, okay. Any questions? Okay, again, I said I'm starting off basic, so this should be nice and relaxing to hear about. Yes, yes. So then your finished product is the steel bar, right? So that's what you make. That's a really good question. So different companies have different levels of finished goods. There's not like, it's only finished if blah, blah, blah. Your finished product could be selling wood, which is somebody else's raw material, right? So you could be like the person who chops down the tree, and then you have like tree bark or something, I don't know, and then, that's your like raw material, right? And then as you like chop it up and it's like not sanded, that could be your work in process. Your finished good could be the wood that you actually sell to somebody who at the next level, that's their raw material, right? So it's a really good question. Any other questions on anything I've said so far? Okay. So in merchandising companies, again, I believe you know most of this. I just want to ease into this discussion of inventory. So in merchandising companies, there are two things happening when a merchandising company makes a sale. Can anyone infer what those two things are? If I took it off my slides, I don't know if I did, but they earn revenue. What else do they do? They incur an expense. What's that expense called? Cost of goods sold, right. Very good. Does anybody know why when we buy a product or when we make a product, it's not expensed right away? Why does it go into inventory? Because of the matching principle. That's exactly right. Because the matching principle says what? We have to match our revenue with the related expenses. Okay, so you can't expense something when the revenue hasn't been earned yet. So the revenue is earned and you have to match the expense with the related revenue. So when you buy inventory, it's an asset until it is sold, then it becomes cost of goods sold. Okay? So again, just kind of keeping things real simple here. So Reblin Shoe Company sells women's shoes. A customer purchases a pair of shoes for $50 that costs $30. Now, I'm going to say here, we're assuming we're in a perpetual inventory world. Have you guys learned about the difference between perpetual and periodic inventory? Okay, that's part of what we're learning about today. So again, this is going to be somewhat redundant until we get to the later stuff. But assuming we're in the land of a perpetual inventory, they're going to earn revenue, and you're going to record the revenue, and alternatively, you're going to record the cost of goods sold. And you're going to credit inventory if you are in a perpetual inventory world. Can anyone tell me what's different if you're in a periodic inventory world? Or should I just wait till we get there? There's something very different. I'm jumping ahead because these slides are going to take us slowly through because they're I made slides that are very slow and organized, but I do think you know a lot of this.
Well, periodic, you don't really count your inventory, you know you count it at the end.
Right, so what would be different when you if I made this sale in a periodic inventory world, what would be different? There'd be something very basic and important that's different. Yes? That's that is something we're going to consider later on in this class, but there's something even more basic than this that's different. If we were in a periodic inventory world, what would be different about what I'm doing here? Yes, you don't make the second journal entry. Why? Because you only account for inventory at the end of the period. Okay? So I'm saying, assuming you're in a perpetual inventory world, you have these two journal entries you always have to make. You record a sale and you record your cost of goods sold. But if you are in a periodic inventory world, and I have slides that are going to take us through this and walk through it, but intuitively, you're not recording inventory with each transaction and cost of goods sold with each transaction. So if you were making a sale in a periodic inventory world, how many journal entries would you make when you make a sale? 1. How many do you make in a perpetual inventory world? 2. Okay? Very basic and very important difference between periodic and perpetual inventory. And again, I'm jumping ahead because I believe you already know these basic concepts, so I can sort of say these things as we go through the process. Okay? So, how much profit did Reblin make on that inventory sale? $20. Okay? So you have gross profit of 20. So Very important here. So well, actually, let me just say this. So in a merchandising company, sales minus cost of goods sold is going to give us that gross profit. And this gross profit is a profit on the markup of a product. Okay, that's what you're showing when you show gross profit. It's your markup, your direct markup on that product. And what's very important here, if you see a multiple step income statement, what does it always start with? Sales. This is very important that you know this. We learned this, so hopefully everyone's telling. What is it? What's at the top of a multiple step income statement? Sales minus cost of goods sold. But I want to tell you something that we didn't talk about before. That's only if you have a merchandising company. Because you don't have cost of goods sold and you don't have gross profit if you are a service company. You only have this if you sell inventory. Okay? So in a multiple step income statement, which we're used to seeing, sales minus cost of goods sold gives you gross profit. You will only see that if you're talking about a merchandising company. So if you went to like the financial statements for H&R Block, they're not going to have sales minus cost of goods sold gives you gross profit because they sell services, right? Okay, so you only see that in a merchandising company. All right, so why does this number even matter? Why do you think this is shown separately? Why does gross profit matter? Yes?
It shows like kind of more or less like how more like operating related expenses over say, well not just well it shows like the initial kind of operating what your inventory is producing as opposed to the other expenses.
Right, and what do you think, who are we reporting for? When we make financial statements, who are we reporting for?
Users, so like banks and like investors.
Right, investors, creditors, right, banks, other investors, those are the primary users of these financial statements, right? When you take cost accounting, you're going to be talking a lot about reporting internally, right? So there's different reports that we make when we're reporting for internal purposes. The primary users of these financial statements are external users. Not to say that internal users don't look at this information, but why might a gross profit number matter in that context? What do you think maybe a user would care about? Why do they want to see that gross profit number separate? Yes? Yeah, I mean, you're totally in the right realm, right? We're talking about, I'm looking more like profit margin, right? So let's say you have two comparable companies. Let's say you have like Home Depot and Lowe's that are showing sales minus cost of goods sold. First of all, within Lowe's itself, you may be looking at trends, right? Is their profit margin, is their gross margin declining over time? Are they spending more money on inventory and not making as much on sales? That could be an indication that they have too much in inventory, that they have to reduce the prices to sell things so that their sales are going down, but their cost of goods sold is staying steady. You could look at Home Depot versus Lowe's and say, wait a minute, why does one have so much of a better profit margin than the other? Maybe they manage their inventory better. Maybe they are able to maybe they have better contracts with their suppliers, right? I maybe want to invest there versus Lowe's because, so these are the kinds of things investors might look at, looking at comparing across companies, looking at trends within a company over time. So this is a valuable subtotal for that reason. Yes?
Yeah, I think you can also compare it to your net margins as well and see how your operating expenses and look at how just go.
So like you have your direct markup, then how much are you spending on other stuff beyond that, you're saying?
Yeah, compare like your profit margin as far as cost of goods sold, and then where your other expenses are coming from.
Right. So maybe a company has a lot of profit, but then spends a whole lot of money on administrative stuff. So you can look at that. Absolutely. Investors and creditors may look at all sorts of different things, but having this subtotal helps to be able to break down and get more detailed information. So, and that's why, again, it's presented separately on the multiple step income statement. All right, so where are we from here? I mean, this is really simple, but I have it up here so we can do this. Bloch Company has the following information pertaining to its business. So you have sales revenue of $400,000, operating expenses of $60,000, cost of goods sold of $310,000. What would be the gross profit? $90,000. So what's important? Why did I point this out to you? Right. It's only cost of goods sold that's included in gross profit. So that's why I'm pointing that out to you. You do not include operating expenses in the gross profit number. Okay? So if you got that wrong on the exam, now I have pointed it out to you again. Okay? So you make sure sales minus cost of goods sold is your gross profit, and that's always at the top of your income statement if you're a merchandising company. Okay. So again, I'm going to go through just a few more things that are quite basic again, but I want to make sure that I cover these before we move on. Yes, questions? Yes, yes, like net sales. It should say like net sales. Yeah. Okay. Other questions?
So, what's the beginning of the income statement of a service company?
They may have service fees revenue, but they're not going to have a gross profit separately, right? Because they don't have cost of goods sold. So you don't see cost of goods sold and gross profit. They may have sales of their services, but you're not going to have this gross profit subtotal. Okay? So inventory and cost of goods sold. So this again, we've already touched on this, that in accrual basis we have to record revenues when earned, expenses when incurred, and so we have to match. So according to the matching principle, that's why we put our items into inventory. They're assets until they're sold. Okay? They're assets until they're sold, then they become cost of goods sold. But according to the matching principle, okay, we have to match revenues and the related expenses. Yes?
What if a company does both services and sales? Like a plumber, like he sells plungers, and he like unclogs toilets. I don't know.
Well, you would have then a component of sales that minus cost of goods sold, and then you would have you have a primary business that you're really in. So you probably would have the sales minus cost of goods sold, and you'd have the other revenue elsewhere. Yes?
For a service company, is there a fee revenue minus salary?
No, because that's a really good question. I was thinking about how to sort of talk about this. I would kind of look at it like this. There's no direct markup on a service, right? There's no, you don't maintain that level of detail. So if you do taxes for somebody, you're getting paid regardless of whether or not you're doing a tax return for a particular person, right? So there's not necessarily, it's not to say that there isn't some direct expense, but it's kind of too far away. There's some direct expense from photocopying, there's some direct expense from printing, there's some direct expense from using the software, there's some direct expense from your salary, but that level of detail is not generally maintained in the service industry. Okay, so it's more the simple way of thinking about it is you're going to get paid to do that, you're going to be paid for your time regardless of whether or not you're actually doing anything, right? So to have to track to the, you do track your time actually when you work in accounting, but there's not generally a cost of services rendered, okay, per se, the way that there is in the world of merchandise. Okay, merchandising companies tend to be much more complex. They have, you get into it with cost accounting. You have materials, labor. You have some overhead that's allocated to the cost of that product. Okay. Yes. But there's not a direct, how do I say this? That's one component, right? That's the main component, but there are other things that go into, so if you're in a contract basis, so when you guys work in an accounting firm, you're going to have your time tracked, okay? But that is not, there is not a method for directly, allocating all the, when you're talking about inventory, there's some overhead allocated in your inventory. There's some materials, there's some labor. So as far as service companies go, yes, you have your time, which is one aspect of what would be a direct markup, but not all of the other items are tracked. I guess I think that's the simplest way to talk about it. It just simply isn't done in the service industry. Okay, so yes, they may, when you work in an accounting firm, the partner is likely printing up how much time was spent on, on that client in a particular period, and there are charges based on that amount of time. So there is some direct relationship there, but it's not recorded as such on an income statement for a service company. Okay? Other questions? Okay. So what do I have next here? And I mean, again, we've said all this. When a merchandising company buys or manufactures inventory to sell, it does not become an expense until they sell it. Until sold, it's an asset called inventory. So, and as I said here, inventory can consist of raw materials. It can consist of goods that are in production, which is work in process, WIP, W-I-P. All of, if you see WIP, that's work in process. That's goods that are in production. And it may consist of some finished goods that either you made or you just purchased goods that are made already. Okay, you don't go through that detailed process. So again, Reblin shoe company purchases women's shoes for resale. In the month of June, they purchased 10 pairs of red leather shoes from a shoemaker for $30 a pair. Where does something like this go? Inventory. If you are in what type of world? Perpetual inventory. Perpetual, well, yeah, merchandising company, of course. Right, no, that's a good answer. But if you're in the world of perpetual inventory, it goes into inventory. Does anyone know where it goes if you're not in a perpetual inventory world? Purchases. It goes into this purchases account. Okay? So in a perpetual inventory world, you charge inventory. Intuition would bring you to a perpetual inventory world. This is where you want to record things. Intuitively, you would make journal entries that would look like perpetual inventory. Periodic inventory is the one that's a little less intuitive. Okay? Because when you buy inventory, you want to put it into an inventory account. But in a periodic inventory world, it goes into purchases, not inventory. Yes? Question? Okay.
So does that mean
Yes?
when you do periodic on your balance sheet, there's no inventory?
There is, and we're going to get into that. What happens is, at the end of the period, you move everything from purchases into inventory. Okay? So it looks the same. Well, it doesn't look, actually, I don't want to say it looks the same. They look similar, right, because the numbers will come out differently, and we're going to talk about why that is. They will likely come out differently. But it will, the accounts that you're going to see on an income statement for a periodic and perpetual inventory system are going to be the same account. It's the way it's recorded during the period that are different. Okay? You want to imagine more like, when you're thinking of perpetual inventory, you're thinking of big, sophisticated companies. Like, can anyone think of a store you go to and you say, how many of these do you have left in stock? Walmart, yes. Another one. Best Buy. You go, right, and you say, you go into Best Buy and you say, I want to buy a Sony 50-inch whatever TV, okay? I don't even know what's out there because I don't buy TVs right now. But if you go to the store and you say, I want to buy this specific item, how many do you have left in stock? They'll tell you, we have 11 left, right? They'll tell you sometimes they'll say we have 2 left. And what do they usually say when they say they have 2 left? They may say you better buy it quickly, but what else might they say? That's very true. Yeah, they may say, wait a minute, it says we have 2 left. Let me check and see if we actually have 2 left, okay? And I'm going to leave it as a cliffhanger, and we'll talk about what that means later, okay? Yes?
Is there a preference, like for larger companies, to utilize the perpetual versus the periodic? Because periodic is like you leave it up to human error to do a physical count.
Right. So that's a really, really good question. So in general, you're going to see that larger companies will likely use perpetual inventory systems, or some hybrid even. It's really smaller, like mom and pop shops. If you go down to your local dollar store, do you think that they're going to buy a perpetual inventory system to maintain inventory? No. It's like too much, it's too expensive. They're not going to say, you're not going to call and say, I'd like to buy gift bags. How many blue gift bags do you have left in stock? They're not going to know. So really you're thinking like larger companies are going to be on perpetual inventory system. Smaller companies may tend to be on either like a hybrid or on a periodic inventory system. Yes?
If you're really small, you can probably do a perpetual inventory system without any expenses, really. If you're only selling a couple things.
You could, but in a perpetual inventory system, you have to maintain the cost of that inventory at all times. That's what becomes complicated. Recording the sale is not difficult. Matching the expense at that time under whether you're on FIFO, LIFO, average cost, like whatever method you're on, which we're going to talk about later, it becomes much more complicated.
You sell like yachts.
Well, okay, so this is a great question. So this is called specific identification. We're gonna get into that. There are certain industries where it's like, you know, I'm selling this specific item and this has a very specific cost, like a car. We're jumping ahead, but that is an area, usually that's done only when you're in like a kind of market where there's a very, very low turnover, where you can specifically identify each item. When you're talking about inventory where you have like larger amounts, that becomes a lot more difficult to really track that. But that's a good point because that is done in certain industries. Okay, so here I was just so I said we record inventory if they sell one pair of shoes. So here they recorded this inventory. They bought 10 pairs of shoes for $30. They sell one pair of shoes for $50. So one of the things that happens in a perpetual inventory world, again, you debit cost of goods sold, you credit inventory to take it out at the cost, right, at the $30. And what's the other journal entry that's missing here? Cash and sales, right, for $50. Okay? So again, if you see a journal entry that debits cost of goods sold and credits inventory, what world do you know you're in? Perpetual inventory. Good. So let's try brief exercise 8.2. Brief exercise 8.2, just to practice some of these entries. Okay. Any questions on that? No questions? Okay, I'll leave it up for a minute and then we'll move on. We're going to start to get into periodic, and then from there we're going to we'll start to get into the different kinds of inventory systems that we have. I mean, the kind of inventory ways of recording inventory. Okay. Need another minute? Yeah? So whereas we put things directly in and out of inventory in a perpetual inventory world, when we get into periodic, we're going to see it's not quite so straightforward. All right, I'm going to move along here. So again, we've already touched on this, so it can be very cumbersome to have to maintain this great level of detail, and it can also be very expensive to maintain this great level of detail. But if you maintain all of this detail that you're recording on a transaction by transaction basis, this is a perpetual inventory system that you're working with. Okay? Many business owners don't want to invest in these types of systems because it's not worth it for them. They're a small operation for whatever reason. So they might choose to maintain their inventory on a periodic inventory system instead. So let's look at what some of the differences are here. So in a perpetual inventory world, we know every item is recorded right into an inventory account. So if you see inventory in the detailed journal entries during the period, you're in a perpetual inventory system. And as each item is sold, it's taken out of inventory, and what do you debit? Cost of goods sold. Right. So cost of goods sold is recorded for each item. So we've named some of these, like Home Depot, Stop and Shop, Bed Bath & Beyond, Walmart, all of these kinds of stores. When you can go into a store at any given time and say, how much inventory do you have of this on hand? And they can tell you, those are perpetual inventory systems. Or they're generally perpetual inventory systems. If you went into a store that maintains periodic inventory, will they be able to give you that detail at any given moment? No, because they don't maintain that level of detail. Okay, so in a periodic inventory system, there is no detailed record of inventory throughout the period. Okay, So during the period, what are you recording during the period? What's the only thing you record during the period as far as when you make a sale? Is the sale itself. You record the sale itself. When you purchase inventory during the period, where do you put that inventory? Purchases account. Okay, so purchases of inventory are recorded in a purchases account. Inventory, this is what you had asked, right? Inventory is updated, the inventory account is updated once per period, and that's at the end of the period. And so you have to physically count your inventory. So how do you know? So you make purchases during the period, and then you count how much you have left, and that backs you into cost of goods sold. So you're going to back into cost of goods sold by figuring out what you purchased, knowing what you started with, and then figuring out what you have left. Okay, so just to kind of summarize this, and then we're going to look in more detail at periodic versus perpetual. So perpetual constantly updates inventory quantities and cost of goods sold. Constantly updates inventory quantity and cost of goods sold. A periodic only updates inventory and records cost of goods sold at the end of the period. Yes?
This might have been kind of what we were talking about before, but
Mm-hmm.
like how would you treat like a company that's sort of like in between those? Like say they have a very small inventory, like maybe only like items that they keep in a small boutique,
Mm-hmm.
but they want to keep it updated so they can tell their customers, so they do a count every day at the end of the day, or maybe every week.
Right, so that's a great question. So there's two pieces here. So first of all, sometimes when the operation is so small and inventory moves slowly, you can have some kind of specific identification where you know exactly what that cost you, and you can record that information as you go through. You know, it's like very, very low volume. Another thing is I think I have a slide on this. Some companies, what they do is they maintain kind of a hybrid. They may update the quantity on hand, but not update the cost of goods sold. Okay, so some of them, the issue really comes with the cost of goods sold. Quantity and costs, because maintaining the cost is very difficult. Some companies will track the quantity and not the cost. Okay, so there are some companies that work in a hybrid system. We're not going to learn any like entries and journal entries as it relates to that, but be aware that that does happen. Okay, we're focusing on like one or the other. Okay, but that's a very good question because that definitely does happen. So. So Reblin Shoe Company purchased inventory of $50,000 on account during the period to resell to customers. What would be the journal entry that they'd make? Debit purchases. If they bought them on account, so you're going to credit accounts payable. So you're debiting purchases. Will you ever see a purchases account on the financial statements of a company? Why? It closes out to inventory at the end of the period. Okay? So you should never have a purchases account with a balance once you close your books and finalize your records. Okay? Purchases always closes out via journal entry, which we're going to look at, to inventory. Okay? So as you're learning this subject matter, that's one of the rules that you have to remember. Okay? Okay. Reblin sold inventory for $35,000 cash. What do we do on a periodic inventory system? Record the sale of $35,000. What else do we do? Nothing. Trick question, right. Good answer. Okay. We don't do anything, right? Because how many journal entries do we make in a periodic inventory system? 1. How many do we make in a perpetual inventory system? 2. Very good. So here, I believe you've seen this before. Beginning inventory plus purchases. What does that give you? Goods available for sale. Minus ending inventory. How do we get that? We physically count inventory. Gives you cost of goods sold. Where does beginning inventory come from? Last period's ending inventory is this period's beginning inventory. Where does purchases come from? It's also called cost of goods purchased, but they're your purchases. Where does that come from? Your purchases account comes from your purchases account. You know, net of any returns and all that kind of stuff. There may be some math you have to do there, right? If someone returns something, stuff like that. Gives you what's available for sale during the period. What's left at the end? How do you find that out? Count your inventory. The difference must be what you sold. That's your cost of goods sold. Once you figure this out, you make a journal entry on the books for this amount. For cost of goods sold, there actually should be a second arrow here. I should probably add a second arrow to ending inventory. I like to say this: out with the old, in with the new. Out with the old, in with the new. So what's going to come out? Your beginning inventory is going to be wiped out. What are you going to replace it with? Ending inventory, right. Okay? Your purchases is going to be wiped out. Let me show you here. Well, actually, let's go through the example. Okay, so let's get to the journal entry. But it's out with the old, in with the new. So the journal entry is going to put in the new, which is your ending inventory and your cost of goods sold. You're replacing your beginning inventory and your purchases with ending inventory and cost of goods sold. So, at the end of the year, a physical count of inventory shows 70,000 of inventory on hand. Beginning inventory from last period we know is 40,000, because that was ending inventory at the end of last period was 40,000. And we counted inventory, it says we have 70. Now remember, from the prior piece, we purchased inventory of 50,000 during the period to resell to customers. Okay? So what would we do here? We have beginning inventory of 40 plus what we purchased. Gives us goods available. Minus ending inventory gives us our cost of goods sold. We're backing into cost of goods sold. Now in this example, I think I said we sold, did I say we sold 20,000? We said 35,000 of inventory we sold, which probably had a value of 20,000. I think I made the numbers work, but that's just sort of luck. That cost of goods sold would be agreeable on a perpetual versus a periodic inventory basis. Okay? We're backing into cost of goods sold. So can anybody think of why that might not be the best thing to do? Anyone think of any reasons why this might not be the best thing to do? Yes? Exactly. You are right on. That's exactly the answer I was looking for. Right? People, stuff happens, right? Stuff breaks, there's shrinkage, stuff is stolen. In a periodic inventory system, you have no idea if it was sold or someone took it, because you just assume that whatever is the difference is between what you purchased and what you had available versus what you have at the end is sold. So that can end up inflating your cost of goods sold, which could then impact your gross margin, your gross profit percentage, which then can impact the way you look versus other companies. Okay? So not knowing the detail, you're making certain assumptions that likely, in a perfect world, nobody would steal and nothing would ever break. But the reality is that these things happen all the time. That's a very important reason why if you go to Best Buy and you say, I'd like to buy a TV, and they say we have 2 left, they're not going to be so sure. They're not going to tell you that you could come in and buy it. They're going to probably check to make sure they actually have that when you get down to a lower inventory number. And we'll talk more about that specific perpetual inventory again in a few minutes. So take a look at this. We have beginning inventory of 40 plus purchases of 50 gives you goods available of 90, minus ending inventory of 70 gives you cost of goods sold of 20. So what did I say? Out with the old and in with the new. So what's the new here? 70,000 and 20,000. There's the new. In with the new. Okay? In with the 70 and the 20. I'm trying to give you just a tool to help you remember how to make this journal entry. In with the new. Debit inventory, debit cost of goods sold for the 2 pieces at the bottom of that equation. Out with the old. Take out your beginning inventory and your purchases. Okay? Out with the old, in with the new. That's your journal entry that makes the books correct. So what can I imagine can be confusing?